Hey guys, how you doing? Werenka here from Simply Home. I'm the state of Michigan broker, one of the fastest growing real estate companies in the United States. And I've got an all-star team. So whether you're looking to buy, sell, invest, rent, whatever you need, we've got you covered. We even do property management now. So with all of the crazy tumultuous ups and downs that are happening in the real estate market and the world and everything right now, I'm going to jump in and just give you my best guess on what we can expect for the rest of spring 2026. So traditionally, spring is one of the top seasons for real estate in the state of Michigan. We'll see a surge in inventory, a surge in buyer demand. The number of homes sold is going to go up. The average sale price generally goes up, except this year we've got all kinds of stuff going on, obviously. So we're going to break that down a little bit, talk about the competing forces that we have in our market right now, and try and make some kind of sense out of where we go from here. And then on top of that, nationally, we're going through what's being called the Great Housing Reset, which means we're not seeing those huge, unsustainable 15, 20% year over year price appreciations. We're settling back down into a more manageable, consistent 3 to 5%. Although some parts of the country are actually seeing prices decrease right now year over year. In fact, we're seeing that a little bit across our market as well. Some of the higher end suburbs, your Rochester Hills, your Birminghams, your Troys, are starting to see prices leveling off, whereas some of our other, more traditional like starter home suburbs, your Redfords, your Hazel Parks, your Madison Heights, are still seeing year-over-year appreciations, just not quite to the same extent that we were. So that's one thing that we are seeing, and I expect that to continue and maybe even increase throughout as we move through spring into summer, is seeing some of the higher end homes sit on the market a little bit longer. That's going to lead to probably price decreases on case by case basis, whereas the market for starter homes, homes that are under $200,000, are still pretty competitive. A lot of bidding wars happening, and don't get me wrong, you can get into a bidding war at any price point in any city on any particular homes. Definitely don't take this as gospel. Everything is a case by case basis. There's certainly exceptions to everything here as well. And the thing that's on the forefront of everybody's mind, real estate related, is certainly mortgage interest rates. We had 2 glorious days where we finally got under the sixes. We were in the fives, the high fives to be sure. But, mortgages had settled into the fives for a couple days there. My lender partner is still processing through all the refinance applications he got when that happened. But no sooner than that happened did we decide it'd be a great idea to go to war in the Middle East. And here we are with rates well on their way to the sevens again. Right now, as we speak, we're in the mid sixes. I think it's 6.63. I believe this week was the national average for a 30-year fixed rate mortgage. But mortgage rates have been all over the place the last few weeks. They've been going every direction but down, generally speaking. We have had a couple of drops here and there, but usually, like, we went a month and the mortgage rate didn't change, and this was back in December, January. It was basically just set at 6.1 for literally like 4 weeks in a row. So this kind of volatility is not something that we're used to seeing. So the fact that rates are just like they went down and now they're just spiking, not something like that we typically see. We like a little more, we definitely see week over week fluctuations here and there, but it's usually within a couple hundredths of a point week over week. We don't go from like 6.1 to 6.5 in a week, which is what happened a couple weeks ago. But I guess I look at it this way. This exact week last year, we were at 6.8% was our average. So we're still doing better than we were, although the faster we can get a resolution to everything that's going on in the world and bring prices back down, that's going to help everybody involved. Now, traditionally, the impact that we see on sales, and I would expect probably that this is not going to be an exception moving further into the spring, is when we see wild fluctuations like that, when we see rates starting to rise back up, that basically disincentivizes homeowners from putting their homes on the market to an extent, just because if you're selling your home, maybe you locked in that 2 or 3% interest rate 4 or 5 years ago, and when rates started coming down, maybe that was worth it to you to trade in your current home that maybe isn't working for you anymore for something that does. But now that rates have gone back up, that equation changes. So maybe a 6.5% interest rate is not something that will, make it worth your while to put your home on the market. And we're going to see that across the board, across the metro area to an extent, which I do think is it's going to keep our inventory lower than it would have been. Although I do think we're going to probably see more inventory on the market this year than we saw last year. And essentially what that's going to mean is that we're going to be somewhere between 2025 levels of inventory and 2019 levels of inventory, which were much higher. On the landlord side, it's actually good news because higher interest rates are going to keep people renting homes that probably would have bought otherwise. And, I know affordability is definitely an issue in this market right now, but the gap between income and home prices is starting to narrow, especially in our market. We're one of the, I talk about this all the time. We're probably the most affordable region of the country right now. And I'm talking about the Midwest in general, Metro Detroit being one of the more affordable cities or metropolitan areas in the United States as well. But that doesn't mean we're not affected here as well. So, and time is going to tell on this one, but generally speaking, higher interest rates are going to keep some people from selling. They're going to keep some people from buying that otherwise would have sold and bought. So, we'll see what happens on the overall effect of the market, but I think it's a fair bet to say that's probably what we're going to see. And while we're talking affordability, the elephant in the room, obviously, is this war in the Middle East right now that's affecting global energy supplies drastically. And I really wanted to kind of, I don't think I'd be doing you guys a service if I didn't research the effect that similar energy crises or disruptions have had on the real estate market or what the real estate market has done during wartime. So let's talk about that for a minute. So what I found was, in general, real estate doesn't really react to like war developments. It reacts to economic developments, which obviously are affected by war. So what happens during war is obviously, and including this one, obviously energy prices are going way up. It's definitely affecting our domestic bond market. And, if you watch this channel with any regularity, you'll know that the mortgage market basically is tied to the 10-year treasury bill. So as the yield on that goes up, that's what's causing mortgage rates to go up from where they were just a month ago. And obviously all of this is raising the inflation rate, which generally speaking is going to lower real estate prices because it almost has to. And realistically, one of the bigger impacts, obviously everything, inflation, everything becoming more expensive, higher energy prices, things like that are going to impact somebody who's looking to buy a home for sure, because you're simply going to have less income to put towards that house payment. But where it really impacts the real estate market, like bigger than that, is in new construction. Because anything in the supply chain is being affected by higher energy prices, and new construction is basically supply chain driven. It's pretty rare for a developer to go in and like cut down all the trees on a plot and then use that wood to build a house. That's not how it works. So they're trucking in lumber and building materials from other parts of the country. And that's like, it just costs more per mile to get things where they need to go when diesel is at $5 a gallon or more than that even at this point. Basically, the entire supply chain is being disrupted, which is costing more money. And it's the net effect is that builders are able to build fewer homes at a time when we need more homes. We have a housing shortage in this country. The whole thing is not a great development for the real estate market overall. Other eras in our nation's history, like I went all the way back to World War II. And I was actually surprised to see, as we were like basically coming out of the Great Depression, we got right into World War II, and homeownership actually went up 10% as we got into World War II. I was not expecting that at all. But part of the reason why that happened back then is the government put rent controls on. So, landlords couldn't, they were limited in how much they could change rent for each property. So what that meant was that a lot of landlords actually sold their homes off to people. And therefore, supply and demand, there were more homes on the market for, basically a stable number of buyers, and more people were able to afford homes at that point. Now, let's compare that to the 1979 energy crisis, which I think is going to be much more a much closer analogy to what we're at now. So in the 1979 energy crisis, energy prices actually doubled at that point, and that resulted in runaway inflation. And the end result of that was mortgage rates getting raised up sky high. Like that's when we talk about in the early 80s when, my parents had a, 16% interest rate or something like that. It was some crazy amount. And that's kind of like the scuttlebutt that we're hearing a little bit on the Fed of, we're not even talking about rate cuts anymore with the Fed. It's more, are they going to raise rates to combat inflation? Which, we're not to that point yet, because as far as I know, like, the inflation reports have been high, but not like super high. We're not experiencing runaway inflation or anything like that, at least not yet. Hopefully we don't get there. But, if that's the case, that's really the tool that the Fed has, is to raise interest rates to, cool the economy, cool inflation. Hopefully we don't experience that, but that's what happened last time. Yeah. So in the 80s, like housing affordability basically got destroyed. It was really hard to make that monthly payment with those sky high interest rates. So that wasn't really a war crash. That was an interest rate crash, if you will. Housing wasn't really affected that much during the Gulf War in 1990. Oil prices definitely spiked, but it was such a brief spike, then they settled back down. During that time period, mortgage rates basically stayed stable. The real estate industry brushed it off. It was kind of a non-issue. So basically what we need to do is just knock on wood. We're going to hope that inflation remains relatively stable and the Fed doesn't have to make any kind of big fluctuations to keep things in check. And if that's the case, we should be able to ride this out relatively easily, but it's way too early to tell at this point. So what I'm really expecting right now is kind of like more of a deliberate and calculated spring market. There's going to be fewer people, I think, that are, bidding on homes on emotion. There's probably still going to be bidding wars on houses, especially the right home. But I would counsel my buyers to, just think long and hard about it. I mean, if it's, you know, if you're gonna buy something because you're gonna try and fix and flip that property, I would tell you right now, that's probably not the right move to make in this market. But, if you're looking for a home to live in and that's the right home, the real estate market has always rebounded in the past. I don't think this is going to be any exception. And we haven't really dipped, but assuming that we do, it'll be temporary. Even if it lasts 2 or 3 years, it is what it is. And, you're going to live in that house longer than that. So by the, 7 to 10 years that you statistically will live in that home, it will have recovered its value and appreciated past that. I mean, I'll use myself as an example. I bought my house in Ferndale in 2005, which was, the last time we had a really high peak in the market, and then in 2008. So, within 3 or 4 years of me owning my home, I was like $80,000 underwater at one point, and now it's worth triple what I paid for it. So, it'll recover if it's a property that, like I said, that you're buying to live in and it's the right home for you. There's really not a reason not to. I always say, the right time to buy a home is when it's the right time for you, and the right time to sell a home is when it's the right time for you. So, that's one of the benefits to real estate not being a liquid asset. You can't just like panic sell or just buy it. It's a more deliberate process. I expect that moving forward. I don't think our transaction volume, is going to be as high as it was in 2025. But I do think that, we might see price appreciation over where we're at 2025. Although I do expect to see longer days on market. The market that we're in right now is really strange. What we're seeing, and I talk about this a lot on these videos, but it seems like the homes that are priced really well and the seller puts effort into that home to make it look, as good as it can when they put it on the market. Those are the homes that are selling right away, and they're still getting, multiple offers on them. In fact, I just closed a house in Birmingham 2 days ago, and we were on the market 4 days, and we got a close to full price offer, just took it. But that's what we're seeing. We're seeing kind of a 2-track market right now for listings, and they're either selling quickly and for top dollar, like real close to full price, or they're sitting on the market for an extended period of time and they're selling for a lot less. So, and there's really not much in between. And we weren't seeing that over the past few years, but that's where we're at now. So like I say this quite a bit on these videos, the days of just sticking a sign in and standing back and collecting, 12 offers in a day are long gone. You're going to have to put some effort into your home to get it sold for top dollar. or you're going to have to price it realistically. And, ideally you do both. But if you do neither, I wouldn't expect a quick sale or maybe even a sale at all. We're definitely seeing many more expired listings hitting not hitting the market, but coming off the market because they failed to sell. I know like some of the things I was saying were a little bit contradictory, but that's because we just have all these forces, pushing the market every which way right now. And I don't know which one's going to win out yet. But one thing I do know is that once I know, you're going to know because I'm going to make a video about it again. But yeah, right now, I just think it's a little too early to tell exactly what's going to happen. A lot of this is going to be dictated by what happens in the Middle East. If we have any kind of a quick resolution, that's only going to be good things for the housing market. If we are dealing with a energy supply shock for an extended period of time, it's potentially not going to be so great for the housing market, but it's too early to tell. None of that's happened yet. I think the faster we can get back to rates coming back down and making it more affordable for people to buy homes that way is going to be a good thing. It's going to be a good thing for sellers because that's not going to affect the overall average sale price of homes. And if we get into a situation where sellers have to start cutting their prices in order to make those homes affordable so people buy them, then it's going to be great for buyers, not so great for sellers. I like a balanced market that's good for everybody, but we're just going to have to deal with what we have as it comes. And all I can say is just keep watching, and I'll keep providing up-to-date, timely information. And if you guys do have any other questions, if there's anything I didn't touch on, or you need any information at all, you want to go out and look at homes, whatever the case may be, or you're thinking about selling, you're not sure how much your home's worth, it's real easy. Call or text me anytime. My direct line, 5622. You can always email me, Werenka at simplyhome.com. I'm on all the socials, so just DM me and I'll respond quick. Until next week, thanks so much, guys. Appreciate it. Anything I can do for you, that's what I'm here for. Thanks so much, and we'll talk soon. Have a great one.